Right, good afternoon, everybody. Welcome to today's Screenshare. So this is Adrian Buthee speaking. Hopefully you can hear me all loud and clear. If you can do, just let me know in the questions box. Just type "Hi Adrian" in there. That would be great. Yeah, today we're going to be talking about trading the stock market, and we're going to be talking about trying to pick bottoms. Horrible phrase, isn't it? But we're going to try and work out how we can try and time the stock market low. You'll have seen that the stock market's taken a bit of a bashing, particularly in the last few days, really. So we'll look at that and we'll try and get an idea about where the low can be. And what we look at today might be new to you, it might not be something that you've looked at before, but hopefully it's something that's going to be really interesting and something that you can use for your trading going forward. To my mind, it's probably the most accurate indicator that I've ever seen, and it's something that, and it's not our indicator. It's something that we use to help us to understand timing, from which we can trade the markets with a bit more confidence. That's what we're going to go through today. And again, it's all about the stock market. We're going to be looking at principally US stocks today, but you could apply this theory, if you like, to UK stocks or sort of really anywhere. There's a lot of correlation in the stock market, so there's a few things we're going to be going through. We are streaming live on GoToWebinar, but also through YouTube, Facebook, Twitter, and also on LinkedIn as well. But keep the questions coming through, keep the chat coming through. It's live and so on. That'd be great. If you haven't already done so, just type hello, type hi, type something like that into the questions box. That'd be great. You should see on screen there just a couple of ideas about how you can do that if you're on GoToWebinar. So please do keep the interaction coming. Let me know, everybody, first of all, have you traded shares before? How have you traded shares before? If you have, is it more as a traditional sort of long only stock, or is it more as a CFD or a spread bet? Let us know, please, in that questions box, just so I've got an idea of everybody's, I guess, experience and so on today. That'd be great. Judy's never traded before. Long only and CFDs for Michael there. Let me know, everybody else. So, say timing the stock market low. Little risk notice. I've got to go through this, unfortunately, but it is important. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. Okay. So what we're going to do is talk about how we trade US stocks today. We're going to talk about in various different orders. I'm going to be all over the place as usual today, but we're going to talk about how we identify and find trades. We're going to talk about using something called the VIX for market timing. Quick yes or no in the questions box. Are you familiar with the VIX? VIX. Just let us know in the questions box there. Edward, you should be by now, I would think. You probably heard me waffle on about it a number of times. Judy, no. Kavada, no. Mark, yes. Tam, yes. A lot of no's. Probably 50-50, maybe 60-40. We're going to talk about that today. You're going to find it really interesting, or at least I think you will. We're going to talk about something called beta. Do you know what beta is? Apart from a Greek letter, do we know what beta is when it comes to the markets? I'm going to talk about that, and don't worry, it's not that dull either. It sounds it, I know, but we'll try and make it. We'll try and sex it up a bit, I guess. Okay, and we're going to look at some charts, look at some opportunities, and so on. Okay. So the first thing I want to talk about is, I'll keep it quite brief. The thing I like about these screen shares, what I like to do is, there's going to be quite a bit of theory, a bit of education in there, and then we'll look at how we can apply it. But we've got to have a broad understanding about how we do things. So sometimes, a lot of people come into these webinars, they're like, oh yeah, I just want to get going. Show me some live trades. What should I buy right now? Fine, it's okay you get like one trade out of that, but actually what you want is to have the tools, the information to be able to identify those trades for yourselves, really, and that's really what it's all about. Having the right trading account is also important. I won't spend too long on this one, but what I would say is that there are pros and there are cons for each type of trading account. The sort of vanilla account, if you like, is to trade traditional shares. You trade with your stockbroker. If you want to trade US shares, UK shares, there's no leverage available. A lot of these places, you put up 100% of the capital. So if you want to buy £1,000 or $1,000 worth of a stock, then, well, yes, you need £1,000 or $1,000 in your account plus any costs. So, and that's it. There's no leverage there. You go long only, so you're speculating on prices rising, and that's basically it. You can pick up your dividends and so on. It's usually more of an investing strategy trade from a shares account, unless you're perhaps in the US and you don't have the opportunity to trade as a CFD or a spread bet because it's banned. So, you would typically, particularly on UK stocks, you'll pay something called stamp duty, which is 0.5% on UK stocks. It doesn't apply to US stocks, and they're liable to capital gains tax as well. So something to be aware of. So you pay tax on your profits. There's something as well called a PTM levy, but it's only £1, and it's only when you trade more than 10 grand's worth of UK stocks. Let's not worry about it too much. Commissions can be quite lumpy on share trading. Typically, a lot of brokers in the UK will charge maybe something like £12.50 a deal. I was actually looking to trade some US stock on my mum's SIP the other day, and I was told the only way I could do it was by phoning them up, and the minimum commission charge was 40 quid. So it's like, I don't really want to be engaging in that. So you've got to be a little bit careful in the commissions, because if your trade size is, let's say, £1,000 notional, and you're being charged £12.50 a deal. £12.50 sounds pretty good, doesn't it? But that's actually 1.25%. 1.25% in and 1.2% out, and 0.5% for your stamp duty. What's that? 2.5%. That's 3% costs. It's actually quite high. So the trade's got to go 3% in your favor before you even break even. But there are advantages. If you're holding positions for a long while, you don't have your overnight cost of carry. You just put up the full capital, so there's no leverage. Therefore, there's no swap fee, there's no funding fee associated with that. Okay, so you can see that there are advantages, particularly if you're holding positions, but if you're looking to trade in and out a little bit more regularly, then it's going to be potentially quite expensive unless you're trading quite big size. Okay, does it all make sense so far? This is probably what a lot of people are more familiar with. The alternative, and a lot of people ask about this, what's the difference between CFDs and spread bets? There's actually very little difference, really. In fact, the spread bet really is a form of CFD, contract for difference. You enter into a contract to pay or receive the difference between your entry and your exit. That's effectively the way to look at it. When you're trading stocks as a CFD, you can get leverage on there, maybe something like 5 to 1. It depends very much on where you live and the broker you're trading with and the category of customer you are, whether you're a professional customer or not. But something like 5 to 1, 10 to 1, it's reasonable enough leverage anyway for stocks, especially given the speed at which they move. You have the advantage of being able to trade. It'll be the same here as a spread bet under UK ESMA law. Long and short, so you can go speculate on prices rising, and you can speculate on prices falling. Now that's a pretty cool thing, particularly in the backdrop of what's happening at the moment. The stock markets will be falling for probably anywhere between 30 to 50% of the time. So if you have the ability to trade short and make money on falling prices, then it does give you a significant advantage over the long only trader who's trading just physical shares. So it does give you a lot of opportunity. It may not be something that everyone's so comfortable with. You could argue that stocks are designed to go up over time, and they certainly do have an upward bias, and the way in which they fall is different to the way in which they rise. But having that opportunity is probably a good thing. No stamp duty, and no stamp duty is a spread bet either, so you're saving that 0.5% whenever you trade, which is pretty cool. No capital gains tax as a spread bet, but by and large they are pretty similar. The main difference, other than the tax issue, is really to do with packaging. If you're trading as a spread bet, you trade £1 per point, but that is exactly the same if you're trading UK stocks as trading 100 shares. Okay, so if you're going to do £1 per point or 100 100 CFDs on, say, Lloyd's TSB or something, they're exactly the same trade size. Your profit and loss, notwithstanding costs differences, will be basically the same. Okay, the value of the trade will be the same, etc., etc. The main difference you're going to have here is largely to do with commissions. Okay, now some CFD brokers will charge you a commission fee, a little bit like they do on shares. So that could be I don't know, 0.1% with a minimum commission of, let's say, £10 on a deal. So a lot of brokers will do that. So whichever is bigger, 0.1% or £10 now 0.1% is fine. £10 depends if you're trading quite small or say modest size. Small's the wrong word. £1,000 for example, again that's 1%. So you're not being charged 0.1%. If you're being charged the £10, it means you're probably being charged a lot more than that. Because it is in fact 1% there. So, the benefit of a spread bet is they do a wraparound commission. So they just widen the spread out a little bit, typically by something like 0.1% over market spread. So it doesn't matter how big or small your trade, it'll be 0.1%, which means if you're trading a modest sized account, you're not getting whacked by the minimum commission charge, which ends up taking up a big lump. Again, if you're trading, say, £1,000 worth of stock, well, you're going to be charged as a CFD if they have a minimum commission charge, probably £10 a side, which is 2%. Is your overall fee. If you did that as a spread bet, it'll be 0.1%, which is £1. So effectively, you'll be charged £2 on it, which is 0.2%. Okay, so the difference in cost is quite significant, which can make spread bets a little bit more attractive because they don't have that minimum commission fee. Is this all making sense so far? I'm probably going a bit of a whistle-stop tour, probably because this is arguably the least interesting part, but it is important. You will have an overnight funding fee if you're trading as a CFD or a spread bet, and that's because of leverage there. It's a little bit like a mortgage is the way you look at it. That, if you buy a 100 grand house, then you put 10 grand down as your deposit. That's the margin requirement in spread betting and CFD terms. And then you're borrowing the money. You're borrowing the full money as a CFD or spread bet, but effectively you pay a funding fee like you do with a mortgage. So for every day you hold that position, just like for every day you hold your house and you own your house, you will pay a mortgage fee or a funding charge for it. The way it typically works is, and it does vary, but brokers will vary on this, but it could be something like 3% plus LIBOR. It's not called LIBOR anymore, but let's call it that for ease of reference. Let's say LIBOR is, 1%, whatever it is. Effectively, your charge will be 4%. Now, that's 4% for the whole year. You divide that by 365 days, and then you've got your cost of carry for holding it for 1 day. So effectively, if you were going to trade £1,000 deal, okay, so £1,000, times that by 4%. So 4% of £1,000 is £40. Divide that by 365 days. That effectively tells you that your charge for holding that will be 11 pence per day. Okay, 11 pence a day for holding £1,000 trade. And that's broadly what it'll cost. Okay, it's a little bit different if you're going short because it's plus or minus LIBOR. Anyway, that's all you really need to know at this stage. So obviously, the longer you hold that trade, the more that financing cost comes in. But of course, if you're trading £1,000 and your stamp duty is 0.5%, then that's £5. Stamp duty compared to 11 pence per day as a CFD or a spread bet. So you've got to hold it for quite a while, best part of 2 months before you're paying more as a CFD or spread bet. And typically you won't be in trades. Most people are not in trades for as long as 2 months as a CFD or a spread bet. So this is why spread bets and CFDs tend to be quite advantageous. There's very little difference in them apart from packaging, but most principally, particularly with stocks, is that minimum commission charge. So just make sure you're aware of what you're doing with that. All right, we good with that? Whistle stop. I probably need a deep breath after that. That was certainly pretty quick, but hopefully that all made some decent good sense. Did anyone learn anything there? Let us know. Give us a quick yes or a no. It's kind of the basics, but sometimes we need all those basics, don't we, from which we can build. But hopefully it gives us an idea. For me, type of trading that we're looking at doing and talking about today, it is very much CFD or spread bets. It gives you that flexibility. It gives you the ability to trade them, trade small size. You can keep the risks nice and low without getting whacked by commission charges as well. All right, good. Okay. Whew. Okay, so if you're going to trade stocks, there's a few things you need to be aware of. Number one, and again, some of you might think, well, this is all a bit boring, but this is important stuff. Okay, earnings. If you're going to trade FX, indices, commodities, you need to know about economic data. You need to know about when things like non-farm payrolls coming out, when interest rate data is coming out. When it comes to trading stocks, you need to know when earnings are being released. What are earnings? This is when the market or the stock reports how well they're doing or badly they're doing indeed. Now, there can be interim announcements that are a little bit sort of ad hoc based on, profits warnings and things like that, but these are not things that are announced ahead of time. So what happens with your earnings though, or a company's earnings, is that they will report when they are releasing their earnings, i.e. they're going to tell you how they've done over the last 6 months, the last year, the last 3 months, whatever it is, and wherever they are. They will report on a particular period of time. Typically US stocks report 3 monthly, quarterly, have a quarterly earnings period, and in the UK it's more every 6 months, so twice a year is the requirement for a publicly quoted company. That said, there are some UK stocks that report quarterly, and that's because they are also listed on the US exchange as well. Okay, the point about all this is that these are potential banana skins. What happens really is that a stock or in any market will continue to move the way in which it was going until new information comes to light, okay, that could then change the direction of that market. Now, that could be down to anything really, but with a stock, there's probably nothing more important than how that stock is doing. And the good thing is that whilst that can have a big shock on the stock price, just like we see on this chart here on Walmart, and it just dumps 5 or 6% overnight, the good news is that we know when those things are happening because the companies inform us of those reporting dates ahead of time. That allows you as an investor, as a trader, to understand where the banana skins could well be. Now, like I said, shock announcements happen from time to time, and there's not much you can do about that apart from manage your risk and trade size effectively. However, you can be aware of when those earnings are coming out, just like we know when interest rate announcements are coming, just like we know when non-farm payroll is coming. That means you can make an informed choice about whether you might like to hold a position over that data. Why is it important to do that? Because that gap there can have a big impact. Now, sometimes you'll be on the right side of it, sometimes you'll be on the wrong side of it. But even if you're on the wrong side of it, you might think, well, that's just 50-50, isn't it? It's a little bit potluck. I may as well give it a go. The problem is when a market gaps like that, you get something called slippage, which means, let's say that your stop loss was here. You're not going to get stopped out there because nobody wants to buy it there. You want to sell it there, right? But no one's going to buy it off you there because the market's closed and it gapped down here. That's where the market opened. That's where you're getting filled. So you end up with something called slippage, which means that the price at which you exited at was not the same as the price at which you entered at, and the degree of slippage is increased over something like, or the potential for slippage is increased by holding positions over earnings. Now, that may be fine for you, might be happy with that, but it does bring in an extra level of risk that you may or may not be happy with. The point is, be aware of it. Where can you find that information? There is a number of calendars that are out there and available, and you can pick those up pretty easily. There's one that I've got here just for ease of reference on Yahoo Finance. It's a pretty reasonable website. You just go to the calendar up here, and they've got their earnings calendar, and this is predominantly US stocks, but you can look for different regions and so on. Have a play around with it. I'm not going to spend forever on this one. But the point is, it just gives you that information about what's setting up, when it's setting up, and all that sort of stuff. I don't know why I'm looking at March this year, but anyway. There we are. So hopefully that's kind of useful. My view is that if I'm looking at making a trade, I'm going to check whether it's got its earnings within the next week or so. If it has, I just make an informed choice about whether I still want to take that trade, because I probably will be looking to close it before it has its earnings. So here we are today, the 14th of June, 2022. If it's reporting within the next 7 days, by next Tuesday, I'll make a decision about whether I'm interested in taking that trade or not. I'll probably take it if there's 2 or 3 days there to give it a bit of a chance to move a little bit before the results. If it's more than a week, I'm pretty relaxed about it, because typically I'm in trades for 3 or 4 days to 10 days, so I'm giving it plenty of time to do something before the earnings comes out. Again, everybody, does that all make sense? Hopefully you're all okay with that. There are plenty of resources where you can get earnings calendars from. I'm not really going to go through all of that here. I just want to give a bit of a top level overview and try and get as much information over to you as possible. Okay. Good. All right. So that's that. Let's have a quick look and move on. So there's an earnings calendar. There's another one. This is on the Nasdaq.com. There's plenty out there. The only thing I'd say probably is just be aware of whether something is before the market open or whether it's after the market close. So sometimes you can get a little bit confused by the date of it. There was some there for 9th of March this year, whatever it is, MongoDB, whoever on earth that is, that was reporting after the market close, Sotero before the market open. And sometimes they'll say AMC, actually write that on the calendar using, again, depends on the calendar you're using. The point is, be aware. All right, good. Good. Okay, so what else do we want to look at? So what I want to do is actually step back, and this is the VIX against the Dow. I'm actually going to take a step back at this a little bit. I'm just going to have a look at some charts here. Okay. Now, I asked earlier about whether you're familiar with the VIX. You're probably familiar with indices. An index is effectively a package of stocks together, if you like. So when you look at how an index moves, it gives you an idea about how the broader stock market is moving. So you've got the Dow, which is 30 stocks in the US, the S&P 500, the UK 100, the FTSE 100, and so on. The VIX is kind of a measure of, and this is when we're talking about timing here. I'm probably going about this the wrong way. Let's have a quick look at the Dow. Okay, let's do that now. And what I want to do is look at that. I'm going to remove all these indicators off. And what we're going to do is have a look at the Dow over the last however long. And what you're going to notice is that this is a market that kind of moves all over the place. Sure, it has these strong trends and so on, but it's kind of all over the place. There's lots of these moves that take place all day long and so on. And one of the things I think we could all probably agree on is that it's pretty difficult to know when the highs are coming in and when the lows are coming in, isn't it? That's probably the hardest part of it. Like, we all would love to know that information, but being able to guess or accurately predict the highs and the lows of the stock market is very, very difficult. We'd all agree with that, wouldn't we? But of course, that's something we'd all like to know, because if we could get that information about highs and lows in the stock market, it would mean that we could be significantly more profitable and pick stocks better and so on. Now, the problem with it is that there is no, where those highs and lows are, it could be very different. Yes, you get support and resistance and so on, but there's no, it's almost random in the way in which it moves. You could say that there's certain sizes of pullbacks, sort of 7% to 10%, which are pretty typical and so on. But where those levels of highs and lows are, it doesn't really follow any pattern, does it? It's almost random in the way you can see it. You'd agree with me there, I would think. The thing is, just because it looks random here doesn't mean it looks random elsewhere. And there is a chart, there is a certain instrument that you can view, which to my mind probably is the most accurate way of identifying highs and lows in the stock market that there is. Is it perfect? Of course it's not, nothing is. But what it can do is help us to get an idea about where we are in the market cycle. Are we high? Are we low? Is it likely to go much more than where it is now? And so on. And this is something called the VIX. Now, I asked a lot of you earlier, have you heard of the VIX before? Do you know what it is? It was probably 60-40 no's to yeses. A few more people have entered since then. So let me know, everybody. Who here has heard of, or you maybe heard of, familiar with, has used in their trading the VIX, the VIX? Have you? Yes or no? Let me know. VIX. Okay, Michael, yes. Francis, no. Mark, yes. Let us know, everybody. Get involved. No, says Raphael. Okay. The VIX is basically a measure of volatility. It tells us it's to do with S&P options. It doesn't actually really matter what it is to do with, because I don't really fully understand, the algorithm and how it's calculated and all that sort of stuff. It's to do with options expiring in the money or out of the money or whatever on earth that all means. It doesn't actually matter what any of that means, because really what it does is it tells us about fear and greed that's going on in the market.
Why is that important? It's important because we're all the same, unfortunately. We all think we're individuals, we have our own view on things, but one of the things is that we all kind of think about things in the same way. When the market starts to come off, we panic a little bit. We start to worry about our portfolios, we worry about our pensions. We think, oh my God, I need to close everything before it gets any worse. And typically, because of that sort of herd mentality and the way in which we're all sort of programmed to behave, the VIX, the fear and greed gauge, or the fear gauge, as a lot of people call it, can really help us to understand how people are feeling about the stock market at any given point. The way it basically works is that, let's look at it on here, and you can use this on Yahoo Finance. Just put the little hat symbol, Shift 6, or the circumflex, or whatever it's called. VIX, okay, that's what we're going to look for. So the Shift 6 VIX CBOE Volatility Index, that's the thing we're going to look at. So when you look at that, it brings up this bit of information here. And you can do that now while we're having a look at it. So yahoofinance.com, Shift 6 VIX, and we're going to click on chart. Okay. Now what this does is it gives us basically a gauge as to how people are feeling at any given point. So if I just fast forward this to where we are live right now, I can just zoom in a little bit. The reason this is important, and what you'll notice is I've got the Dow overlaid here, so this line here. Again, the random nature of the Dow is well, random, it's exactly that. But the VIX isn't. There's only so much pain or fear and greed that humans can take, and what you'll find is that there are certain levels, certain highs, certain lows, and so on, that typically, occasionally you get these sort of outliers where the market's just going nuts. But there are these typical levels of fear and greed that stop the market doing much more. Okay, so what happens is that if everyone's panicking, everyone panics within a short period of time, and by that point there's no one left to panic, which means there's no one left to sell anymore, which means the market's gone down about as far as it should do. And typically what finds is the more everyone's panicking, you're panicking too, and you're like, oh my God, just sell stock. Actually, you need to take stock. Pardon the pun, use the use of the word stock. Is that actually when everyone else is panicking, you should be looking at opportunity. Because if everyone else is panicking, they're unloading stock, they're getting out, market's falling. You need a gauge that can help you to say, right, this is kind of optimal fear right now. This is when anyone's panicking. So if you've not got any sellers left in the market because they've already sold, what are you left with? You're left with a lot of potential buyers. And the more buyers they are and the fewer sellers there are, the more buyers are going to have to pay higher prices in order to get their stock, basically, to get their portfolio weightings up, whatever. So what happens is that they have to then drive prices higher because there will be more buyers prepared to pay higher prices. And whilst the stock market's highs and lows are almost random in price terms, the VIX is not. They are quite horizontal in price terms. It's not a perfect science by any means, but you look at these levels, these highs and lows here. That's the VIX. That's the VIX typically saying, oh my God, we're about as full panic mode as we're likely to get, unless something cataclysmic is going on, like here, which is the credit crunch, late 2008, 2009, and then here, which is COVID-19. It is unusual for the market to really overextend on a fear basis. So basically it's the higher the VIX is, the more fearful this market is. The lower the VIX is, the more complacent the market is. And that's useful in itself for identifying highs in the market too. It's just not quite as accurate as a timing indicator. Effectively what I'm saying is the more fearful this market is, the higher the VIX is, the closer we probably are to a stock market bottom. And if you get around to a number of approximately 30, it's pretty close. It may not be nailed on, and I'm certainly not giving investment advice. It's just an educational thing to say, have a look at it, do your own homework. It gives us a bit of extra color to say, right, if it gets those sort of levels, then we can be quite interested in looking at stock, maybe picking up something for the portfolio, perhaps at a better value proposition than it was previously. When you see the VIX down at typically sort of 10, 11, 12, that's usually telling you that the market's pretty complacent. It's a bit like when your nan rings you up and says, "Oh, my love, I see that these stocks are looking really good at the moment. Is now the time to buy and go long?" Well, with all due respect to my nan, bless her heart, whenever she rang me about that sort of thing, that was the time that I should sell and get out of the market, because she would be the last person to ever to sort of suggest it would be a good thing. So if everyone's talking about it's in the stock market, in the media, everyone's talking stocks up, it's effectively probably the time that the market's hit the top. So your nan signal, bless her. But anyway, the point about it really is that you can see where these things are. All right. And I can want to sort of show you this. It's hard to compare some ways, but I'm gonna see if I can do my best. So bear with me. I don't want to look at a weekly interval. Look at a 1 day interval, and I want to look at yeah, I can do that. And let's see if I can just refresh this, because it's a little bit potluck with this chart, just to try and get it looking in a nice clean kind of way. Bear with me. Okay, so what I've got here is the VIX, which is the candlesticks of the VIX, and then this other line is the Dow. This doesn't. Let me see if I can get this a bit better. That might be a bit better like that, actually. Okay. What I want you to do is, you see the VIX is quite volatile, so it moves in percentage terms a lot more than the Dow, so it kind of tightens this up a little bit. What I want you to do is, whenever you see these lines up here, I want you to look at what's happening here. Okay, so it is an inverse relationship, basically. So whenever the VIX is high, you'll see that typically the stock market is low. And the reason this is important is because at about this level here, messes with the scale for some reason. This is about 30 on the VIX. When the VIX gets up to 30, it's basically saying, sharpen your pencils, basically. Let's have a look at it. So we get to that line, that black line there. It's around the 13th of May last year, and you can see the stock market had a bit of a decent enough fall. I can't really show you how much it is, just the way that actually went from 35,000 down to probably fell about 1,000. I don't know how much it fell. It's hard to tell. It fell a decent amount anyway. Again, here you can see that the VIX, the fear, went up to its natural extremities. So the elastic band of fear was stretched as much as it might normally do, and that was coincided with the stock market fall to there. Okay, again, stock market fall. That's quite a big correction, that. In fact, it's fallen about 10%. And here, there's the VIX, it's the lows, and up the market then went. So when you get to that big fear level, then suddenly that's it. Everyone who sold has sold, and then the market then can look to correct. Here, stock market low, up it went. Here, harder to pick there. It was a little bit more challenging at the beginning of this year, but again, big market rally from there. And you can see once again that this is where we are now. So the VIX is currently above that 30 level, whilst this stock market's in free fall. We are right on it as we speak. So the question is, I guess, is this a stock market low? We'll probably find out. History would suggest that, when the VIX goes above 30, occasionally it gets it wrong, but by and large, it's the low within 2 or 3 trading days. Okay, and it's at that level now. So what that does is it gives us an indication as to how this market is more likely to move. Okay, and you can see again how, again, the inverse relationship is what we're looking at. High on the VIX, low on the stock market. So the fear, as the stock market falls like it did here, fear rises until it gets to a point, a crescendo, where it can't take any more fear anymore. The VIX tops out, stock market bottoms out, and then up it goes. It's just kind of a little bit more tricky to demonstrate this sometimes. Does this make sense, though, everybody? Could you give us a quick yes or a no, please, in that questions box? Sometimes it's hard to really demonstrate. What I would say to you really is this. that if you are interested in trading shares, UK stocks, US stocks, even indices, you should keep your eye on where this market is trading. Because if it is trading above, say, 25, approaching 30, it's getting to a very interesting time. Okay, so it means sharpen your pencils. It means, look out for something that's likely to happen down at this market. If the market's up at 30, should you then be shorting indices? Day trading is fine, of course. Should you be shorting an index normally, unless there's something really crazy going on, like we had with COVID, like a stock market massive crash, like we had in the credit crunch? No, or at least history would suggest no. And often, when you find it, say, you're feeling the fear as well. You're seeing that, oh my God, this stock market's down 7 or 8, 9, 10%. Oh my God, it could really keep on going, couldn't it? It always feels like that. And yet, vast majority of the time, it'll reverse on a sixpence. Okay. Now, I am not for 1 minute saying, oh, it's at 30. Adrian says we should buy it here. You've got to do your own homework. You've got to do your analysis and you've got to select the stocks accordingly. You've got to be able to be in a position to buy the right equities at the right times. This is just simply to give you a guide. Set a price alert. You see it above 25, get it to email you something off whatever you're looking at, whatever it is. So at least you've got an idea. Or at least maybe you see the stock market down 5%. Just get that framed in your mind. Say, oh, let's have a quick look at the VIX. Let's see what that's doing. Does this apply to a specific index? Well, actually, this is really specific to the S&P 500. It's based on the option expiries for the S&P 500 stocks, as I understand it. However, I've actually found, Colin, that the closest relationship, the closest inverse relationship that the VIX has is with the FTSE. That's what I've seen anecdotally in the past. That's not to say you get the best volatility out of the FTSE, but the mirror image that it is tends to be at its highest on the FTSE. So you can see it there, can't you? It's actually a lot clearer on this example now, isn't it? Peak and trough. Peak and trough. It's actually touching it, to a lesser extent there. Peak and trough. What's going to happen here, we'll find out. Again, peak and trough. If I just give you a few sort of ideas, there's various dates that I've written down, and then it's just about having a strategy that you can pick up those opportunities from there. Now, this is all cool, interesting, I hope. The question is, what can we then do with that? Well, we'll talk about identifying individual trades in a second, but what I want to do first of all is start to think about something else, which is beta. Now, I'm trying to cram in as much as I can in this hour, so I might be going a little too fast, but the recordings are available and so on. The question is, which stocks you're going to trade. Now, you'll be aware, no doubt, that some stocks move faster than others, and you can actually know that. That's not to say that they're ready. Each individual stock is ready to buy now. It's just that you can get an idea of like, oh look, well if the market's at a major low, and I think the market's going to go up fast, then it'd probably be quite helpful if I've got a strong appetite for risk. It might be helpful for me to jump into faster moving stocks. So effectively, if the stock market's at a bit of a high, and I think it might come off, you tend to switch into slower moving stocks or acyclical stocks, stocks that tend to do well or better in more challenging markets, like I don't know, Johnson & Johnson's held up, for example, because let's face it, even in a recession, we're probably not going to buy less shampoo, are we? Or at least I hope we're not. So in which case, a stock like Johnson & Johnson will probably hold up relatively well. Reckitt Benckiser, we're not going to buy less bleach probably, because hopefully like to think we're still going to clean our houses. Water, Severn Trent, some of these companies are, they don't tend to fall as fast as a stock market will fall. However, if you are in a recession, will you need less mining products? Will you need less house builders? Quite possibly. Will you need less banks because you're not going to be so confident, so you're not going to take out loans and you're not going to take out a new mortgage? Yes, probably. So in which case, you have your higher beta stocks, the markets that will tend to move faster, banks, technology, mining stocks, these stocks tend to move much faster than the index itself. So if an index moves, let's say 1% in a day, typically, all other things being equal, you would expect bank stocks, technology stocks, mining stocks will move faster than 1%. Conversely, utilities, household, pharmaceuticals will typically trade and move less than 1%. So this is again all other things being equal. So water company, again, we're still going to use similar amounts of water, and it's whether it's a recession or otherwise. But we are certainly going to buy less iPads if we're in a recession, aren't we? You would think. Um, so there we are. The question is, how do we know? If we can look at stocks, think, wow, it's a big stock market low. That sounds kind of attractive. I probably want to be buying some stocks right now, but actually, I quite like a bit of risk. So what I'd prefer to do is buy a stock that's actually more likely to roof it a bit faster. I don't really want to put all my money into Severn Trent because we're not going to suddenly use more water. What we might start to do is feel really confident, and then we're going to go on more holidays. We're going to do this, that, and the other. In which case, let's get into stocks like that are likely to move faster than the stock market, which means I've got a greater potential for making additional capital. How do I measure which are faster stocks than others? Well, it's the beta. And this is something, this is a couple of excerpts or snapshots from the markets.com platform, which actually shows the beta. So if you go into key statistics within each stock you look at within the platform, it'll tell you the beta. The beta is effectively a coefficient. It's a bit like saying the multiple in which they will, the speed in which they will move. So if the index, i.e. the FTSE 100, the S&P 500, if that moves 1%, what would the multiple likely be? Typically, that will move 2.12%, Tesla. The Severn Trent, for example, if the FTSE moves up 1%, all other things being equal, you would think that Severn Trent will move up 0.39%. Does Severn Trent therefore become a really attractive stock to buy, after a big stock market crash? Probably not. It might be helpful to have in the portfolio for other reasons, having said that, but it's probably not one that's going to outperform back to the upside when the recovery does eventually start, if it eventually starts. And again, this is all down to one's individual appetite for risk. I'm certainly not saying, stock market's, so the VIX has gone to, so what Adrian's basically saying is this: the VIX has gone to 30, so I need to load up on some stock now. And what I need to do is just get into the craziest, fastest stocks going. I'm not saying that at all. It's all part of a strategy, and it's all based on your own appetite for risk. But what I am saying to you is make informed decisions. That's all I'm trying to do at this point, is give you the ability to make an informed choice. Okay. Everybody, yes or no? Are you still with me? Is this still making sense? Do you feel that some of these things are things that you can use? This is not like an all-day lecture where I'm going to go through everything in all the minute sort of detail, but this is hopefully going to spark a few ideas from which you can go off and perhaps do a little bit of research. Maybe think, actually, do you know what? Yeah, I can see how I can use that. And each time you then make a decision going forward, it'd be quite interesting to see what's going on with this type of thing. I think that'd be useful. Is the beta related to the ADR? I suppose so, Michael. I'm not actually sure how they calculate the beta, what it's fully based on, but the ADR be the average daily range. I suppose it's a similar kind of measure in a way. But what you don't tend to see on these sites or anything is what the typical ADR is. It can be very hard to find that information, whereas often sites do report on the beta for it. So I guess it's a similar gauge, Michael, for sure. Okay. Good. So, again, give it some thought with your own trading. Now, in terms of stock selection, what do we need? Well, ideally, from a stock selection basis, we kind of want something that can help us to spot trades on an evergreen basis, i.e., when the markets are not just after a crash, but we want something as well that can help us with timing which stocks are more likely to buy, and so on. So, we have our own stock trading strategy. And you can trade this, on its own, as it were. But actually, what I tend to find is that the performance, and it comes in sort of boosts and bursts based on the stock market. So if you can probably say that yes, you can trade stocks every day of the year if you really want to and take up new opportunities and so on. But I would say actually the lion's share of the performance from stock trading, particularly if you have a long only strategy, comes from a little parcel of a week or 2 weeks, probably 3 or 4 times a year. So actually, the lion's share of the profit potential comes from being able to identify where those key opportunities are. Typically a 5 to 10% stock market fall. You see the VIX boosting to 30 and 30 odd, 28 plus, and then at that point you can then start to look at stocks. In my experience, particularly the type of markets we've had over the last 5 years, that will tend to contribute a very large proportion of the profit that is available for that year. So what does that ultimately mean? It means that we probably don't have to trade every single day. In what we do have to do is say, oh, look, stock market's fallen a little bit. Let's have a quick look at the VIX. Oh, that's interesting. Maybe we'll look to trade for a couple of weeks or a month, maybe. And then we'll perhaps hang up our boots, put us, for a couple of months until the next time, because often that's where the real profit potential actually is. Now, with trend signals strategies, as a lot of you will know, it's really down to looking at those turning points in the markets. Whenever this line here changes color, this is a potential turning point in the market. Now, you'll notice that what you've typically got on here are buy trades. This is a long only strategy for the sniper disc. So when the right type of parameters are in place, those discs will pop up on the chart, and it analyzes for what have historically been consistent performing patterns, such as weekly trends, monthly trends, chart patterns, candlestick patterns, degree to which markets are overbought or oversold, the way in which momentum's moving, and so on. It's all built into a framework from which the snipers produce these discs, produces a potential trading opportunity. What that's effectively saying is these turning points with the discs on the chart, have a history, the setup at that stage, the circumstances around that have a history of producing extremely good trades. And that's what the snipers are there to do, is to alert those patterns to us as an end user that they are repeating themselves. So like here, for example, look, okay, it's a turn up. There's the buying opportunity in line with an ascending weekly trend, ascending monthly trend, ascending chart pattern, the intermediate trend, that blue line as well. You've also got the momentum moving up too. There's a number of things that are effectively saying, yeah, this is looking pretty good. Did that coincide straight after a major stock market fall? Actually, it did. Because I'm just looking at the dates of this. It's interesting, there was a stock market fall there. The VIX did go down to, or rather up to about 30 at that point back in February last year. And what happened from there? Well, had you have taken the Dow trades alone, just the trades from the Dow markets for the next sort of week to 10 days, the cumulative profit was around 66%, 66.7%. It was pretty nutty. But what happened was you're building a number of things into it. You're seeing the pullbacks. You're then getting the timing right. You then have the system to be able to identify you the opportunities that are moving and the ones that are identifying the best signs of technical patterns on top of the fundamental patterns you've already looked at as well. So when I say fundamentals, the fear and greed and so on. On top of that, you've got the market timing, you've got the stock timing to help us to identify that as a particular trade. Okay, so this is what the strategy is all for. You'll notice that on the momentum stock strategy, I'm not going to spend too long on this one because, again, it's sort of an educational thing really as much as anything else. I want to share with you that some of the tips and the tricks that we look at that help us to understand the market, and then we use the system to be able to trade that alongside that understanding. So we have the trend following snipers, directional trend snipers, failing trend snipers. Effectively, the pink ones are one of my favorites actually. So as the market starts to change direction, as the longer term trends start to reverse, those pink ones will come in. There's one of those there. So they have a different inner color depending on what's going on. But this is the trend signal system, the momentum stocks system. You can have this on your device at home. You can have it on a laptop, a smartphone, a tablet. So when you see the markets in the right shape, i.e. the VIX is in the right place and so on, it can help you to identify trades. Or you can not worry about the VIX at all and just trade it all anyway. That's entirely fine too. Now, because you can look at the S&P 500 stocks, you can look at some UK stocks as well. What that does is it gives you flexibility because there'll be quite a few of these. There's on the Dow 30 stocks, you typically get just under one trade per month per market, okay, per stock. So if you look at 500 stocks, you're probably going to get about 400 opportunities out of the S&P 500 per month. That's quite a lot. You don't have to look that far afield, and a lot of our members just trade the Dow 30 just to trade a more manageable list. But of course, what you could do is then look at the bigger list and say, well, let's have a look at some of those higher beta ones. I like that stock. That's a nice looking chart. What's its beta? Oh, it's 1.7. That's interesting, because if it does go up and the market goes up 5%, well, this stock's probably going to go up 7 or 8, 9%. That's quite attractive. And it's just having that understanding that allows us to outperform. And that's something that just having that little depth of knowledge, just following a system's fine, but sometimes putting that little sort of intellectual buy-in, it just makes it a whole lot more satisfying. We get the buy-in into the process, we get the sort of emotional, intellectual commitment into it as well, which makes it a whole lot more satisfying. Yes, the results are good, but of course you know as well that you've done a really good job by identifying, putting that extra color into that performance as well. That's what I certainly like about it anyway. Performance of the strategy. So if I look at this based on the momentum stock strategy, it's a particular one of the programs that we provide here at Trend Signal. This is the performance of every single trade over the last however long. A bit of a pullback, as you might expect, as the stock market's fell back. So there's a few losses there. This is the zone that's really interesting at this point with the VIX where it is. But you can see there's been over 1,300 trades over the last 5 years or so. And you can see the results there. So you can look at 1.5% targets, 3% targets, 5% targets. This is zero discretion, really. Just looking at a very simple vanilla target. Alternatively, you can go for the active stop, which is the indicators change direction. Let's have a quick example of an opportunity like that. So, for example, if I look at so we look at Nike. Oh no, that's not Nike at all, is it? Look at Nike here. So there's your entry a little while ago. Rallies to its high. That's like its best price. See the indicator turns back red again here. Close of that bar. That's what we call the active stop. So as the price rises, there's the buy. I don't think I need to spend too long on this strategy because it's pretty straightforward. You've got a disc there. You're looking to buy it. Some of our members will be looking for something like a 5% target, which is a pretty good solid target to go for without having to spend much time thinking about objectives and stuff. So if you're in at, let's say, 115, times it by 1.05 and you get your objective. Okay, so fairly straightforward. If you want to try and get as much of the move as possible, as that market starts to rotate back down again, turns, trend direction starts to fail, you can look to close that opportunity out. So as a line turn from green to red, close of that bar. That's like a hard exit, our active stop. This is actually the strategy that produces the best results. So we can go for 5% targets and stuff like that, but actually what you tend to find is that over time you've had a much higher cumulative gain by running the active stop and much better reward to risks on those opportunities as well. So the average win is 2.4 times the size of the average loss making trade. And in fact, of the recent trades that we've had, just to give you an idea, we had the likes of JP Morgan, Microsoft, Home Depot, Boeing, an interesting one. That was a big move there. So long from 127 up to 142, and that's a sort of 12% move, something like that. Decent. But look at it now. It's really spun off, isn't it? But of course, there was the buy. You can go for a small target, 5% if you want to. Went way beyond that. Well, there's your active stop to help you to exit the trade before it gets any worse, basically. And that's really it. Now, in terms of short selling, you can do that if you want to, and we'll teach you how to do that. Difference between short selling and buy and going long only is that stocks move down a lot faster than they move up. And it's not for everybody. Not everybody likes it, which is why it tends to be more on a discretionary basis. Um, but that's it really. The purpose of today is to, if you're going to trade stocks, there's some things you need to know. Okay, so let's just summarize very quickly what I've gone through today. Number one is that you need to be aware about what type of trading account you want. I just gave an overview. I'm not here to recommend anything necessarily, but you need to think about costs. You need to think about the ability to go long and short. You need to think about, tax implications and so on. What you also need to do is think about corporate earnings. So if you're going to trade stocks, you need to be aware of whatever stock you're looking at trading, when is its next earnings date? If you really want to know, you go into the earnings calendar and you say, okay, well, I'm going to look to trade, I don't know, Nike. So I can just type in NKE, hit in there, and it will give me the next reporting results for Nike. Now, that's not been announced yet because we're not in the next quarter, so it'll come out in due course, basically. But it's not something we need to worry about at this point. What we also need to do is think about we need to think about the VIX and where the position of the VIX is there. Again, we can look at Yahoo for that. It's a pretty decent resource. That's your symbol, okay? So the hat symbol, VIX, be aware of where that is. You can see us now, we're up 6 today. We're taking us above 30, which is making it an interesting zone for us as an investor. Stock selection, this is more just up to you really, but if you want to take that additional risk, then you can think about potentially the idea of using the VIX. Anyone got any stocks you'd like me to have a look at? I can very happily look at any stock for you if you want to see what that VIX is. So if I wanted to look, so this is, just bear with me. I mean, this is a Rolls-Royce. Yeah, we can look at Rolls-Royce. Let's just put it there. So go to Rolls-Royce, key statistics. The beta for that is 1.6. All right, so Francis, it's reasonably fast. Okay, so it's faster than. Oh God, I've paused it. So it's faster than a lot of other stocks that are out there. Okay, BP. Remember BP, it's near enough to 1.2, a little bit faster. You'll find that the bigger the stock, the more it's going to be close to 1 because it's actually moving the index itself. So Colin, historically, the beta of BP was pretty much bang on 1, as was Shell, because actually BP and Shell made up about 20% of the FTSE. So the beta is a measure against the speed in which the index moves. So if they make up a large proportion of the index, then the beta, of course, is going to end up being closer to 1 because they dominate the speed in which the index moves. Does that make sense? What else do we want? Amazon. 1.25. Okay. Tesla was pretty high up in the 2s. Uber. Where would Uber be? Pretty high, I would think. Doesn't have it. It's not recognized. Maybe it's not measured on that stock for whatever reason. Who knows? But there we are. All right. But it's something to absolutely be aware of. And then in terms of trades, look, if you're interested in trading stocks, you're absolutely going to need something that can identify the opportunities and where they are. You will notice that when you look at the performance in this, any downturn on a long only strategy is going to be when the stock markets have a bit of a pullback. Okay. But whenever that typically happens, look what's happens next. The recovery can be extremely fast as the market then goes straight back up again. Now, will that happen again going forward? Who knows? We don't know, do we? All I can do is talk about the typical relationship is that, you have a stock market pullback, we don't tend to we'll get some trades long over that period, and they tend to be a little bit unpleasant just because, well, like any long only strategy would be, but it's how it recovers out of that. It's that starting point when the market then picks up again. You then get that boost in performance typically over that period as the market then has a good rally higher. And like I said, you'll see this from time to time, time and time again. Back in February this year, like around here. The stock market in a week picked up around the momentum stock strategy picked up around 26% over that period. So, really nice moves. January 21, which is here, that was a 66% rally there in cumulative profit. This period here is 159%. These are big moves. And the potential is there if we know how to capture it and we know when to capture it. But hopefully today will get you a little bit closer to that information. Guys, let me know. Has today been useful? Give us some feedback. Let me know into the questions box, please. That is pretty much it for me. This is Adrian Buthee. I've been talking about trading US stocks, talking about how we can look to capture opportunity from trading stocks, particularly after a bit of a downturn in these markets. If you're interested in using trend signal strategies and learning a bit more from us, go through our coaching programs and whatnot, then please do get in touch. Information is on screen. You can give us a call on 01234 757 553 or pop us an email, or you can follow us on Facebook, LinkedIn, Instagram, Twitter, whatever, on everything, anything and everything. So just get in touch. But like I said, any feedback will be very, very well received. Any topics you'd like me to cover off on in future Tuesday lunchtime sessions, again, very happy to go through that stuff as well. Just do let me know. All the best with your trading, everybody, and I do mean that. And I'll hopefully catch you next time. Bye for now.